Hey, and welcome back to Financial Accounting here at Stevenson University. We have made it to week 8 in this course, and today we're going to talk about cash and receivables. With respect to cash and receivables, we're going to talk about a couple of things related to what we talked about last week, like internal controls. We'll carry on that internal controls conversation as we talk about cash and how we control cash. We'll also discuss how to prepare bank reconciliations, report cash on the balance sheet, what that balance means for cash. We'll talk about the different types of receivables, like accounts receivables, notes receivables. We'll also talk about um, the direct write-off method and allowance method as it relates to uncollectible accounts. We briefly talked about that, I believe, about 2 weeks ago. We had a conversation related to what happens when there's an uncollectible debt. So we'll elaborate a little bit more on that. We'll talk about the accounts receivable on the balance sheet, how that looks. We'll talk about notes receivables. We'll do some ratios. We'll wrap up with a conversation on petty cash. So I want you to recall that there are two methods or systems with respect to accounting. We have the cash-based accounting system and the accrual-based accounting system. In the accrual-based accounting system, we record our revenue or sales when they're earned and the expenses when they are incurred. That is the accrual-based accounting system. When it comes to the cash-based system, we recognize the revenue when the cash is received, and we recognize the expenses when the cash is paid. So that's the primary difference between the accrual and cash-based accounting systems. Now, for this course, we take everything from the perspective of the accrual-based accounting system. So I want you to keep that in mind. Now, as a owner, manager, or an accountant, you need to really understand how the business accounts for cash and receivables, how this receipt of cash impacts our sales, ultimately net income, and how that cash is received with respect to an account receivable. So, just things to keep in mind. So first, I'd like to talk about the internal controls that we briefly discussed last week, and I'd like to continue that forward. And I want to do this with respect to cash. So just like we talked about last week, we have internal controls for methods of safeguarding our assets, right? We talked about that last week when we talked about internal controls, fraud and detection, all that good stuff. So, carrying on with that conversation, with respect to cash, it's super, super important that we have a control process for our cash. Cash, of course, as you know, is probably the most vulnerable asset that the business has. There's a great risk of dealing with cash. It's easy to conceal, doesn't have identifying marks or links to ownership. So it's relatively easy to take it with respect to fraud or theft. So we need to safeguard our cash. And the cash that we receive from our customers really done in one of two ways. Over-the-counter sales, where there's an exchange for goods and services over the counter with respect to getting cash right away, or that we have accounts receivable, where the customer pays us later. And the way that the customer pays us is they'll typically write us a check and we'll receive it in the mail, or they will do like a direct deposit or EFT, electronic funds transfer. So I want to talk about the two most common ways that we receive cash. One is over the counter, exchange of goods and services for cash right away, or the other way is we receive a check in the mail at a later date. So over the counter, we have our cash register that helps us to control the cash that we receive right away. And for the mail, we receive a check in the mail, and that mail goes to the treasurer. Then eventually we deposit it into the bank. So that's the overall process of receiving cash. We also need to make sure that we have a strict control process for paying our bills. And we do that through what we call a separation of duties. Now, the separation of duties means that we have two separate individuals that are responsible ultimately for making payments. One, the same person receiving inventory should not be the same person paying for the inventory. Okay, that's just what we call a separation of duties. We need to make sure that we keep those responsibilities separate by separate individuals. We call it separation of duties. And the reason why we do that is because it helps us to mitigate any type of potential fraud that might happen. And we also need to secure the way that we pay our bills by check. Now, I'll give you a quick example of when I was working in the hotel business. When we would pay our bills at the hotel, the way it worked was we would receive the packing slip, match that with the invoice. We would put that into our accounting information system. We would then print a copy of the check out, and we would make copies of everything and bring the original check along with copies of the documents for signatures. And each check required two different signatures. These are authorizing signatures. One came from the controller, and the other one came from the general manager. And so both of those persons would have to sign the check in order to issue the check, right? It was just a way of checks and balances, if you will, to verify that everything we're doing is above board. So those are internal controls over our cash receipts and payments of cash. Now let's talk about receiving cash through the mail. Very common that your customers will pay you by check or by money order or by electronic funds transfer, meaning direct deposit into the company's account. They might also pay by Venmo or by some other electronic means. Okay. Regardless of how the customer pays, we need to make sure that we have a process in place to safeguard those transactions. Now, here we have an example of when we receive a check in the mail by our customer. Okay, so here we have a situation where a customer pays us, we receive their check in the mail through the mailroom. The check makes its way to the treasurer or to the controller's office. Someone from that office deposits the check uh, along with the list of checks using the deposit slip at the bank or a bank bag, and then they bring the cash and checks and other types of deposits to the bank and make the deposit. The um, remittance from the checks or copies of the checks make its way to the accounting department, along with any other cash receipts, and all of that gets posted to our accounting information system. That's the process for receiving payment through the mail. Yeah, very, very straightforward. It's organized and it makes it's a very responsible system, and it's great for our internal controls. Okay. Now, we also have a process for our payments, and this is pretty similar to the process that I explained to you that what we did at the hotel. And so in this example, we have a four-step process, and everything gets matched up before we even issue the check. So the first thing we do is we have a purchase order. We send that purchase order to our vendor. Our vendor then sends us the inventory. The inventory gets matched up in our accounting information system. We later receive the invoice from the vendor. That vendor the invoice gets entered into our accounting information system, which matches the inventory that's in there, and all of that makes its way onto our receiving report. Remember, the receiving report is like a packing slip that you would get in the box, right? And so we would take the purchase order, the invoice, the packing slip, match all of those up, and then issue the check. We'd cut the check out of our accounting information system. So in other words, this increased our accounts payable, then decreased our accounts payable when we issue the check. And all of those numbers match up. So that is a great system for us to be able to track our payments, right? It's we call this a paper trail. Super important in business that you have a paper trail because God forbid you ever get audited for whatever reason, you can prove to the IRS that this transaction actually happened. Another thing that you'll learn about, and this is a very important part of the accounting process, is called bank reconciliations. A bank reconciliation is a document that identifies and explains the differences between the depositor's record and cash account and a bank record of the same cash account. Fancy terms for just saying, hey, I got this document at the end of the month from the bank. It shows me all the cash that went into the bank, all the cash that went out to the bank. The cash came in from our customers, checks and cash receipts, and then cash went out from the bank through the payment of bills by checks, right? And so the bank reconciliation process helps us to match what we have in our accounting information system to our bank statement. The comparison between the two, if there's any differences, we adjust our accounting information system to match what's on our bank statement. And oftentimes those differences are derived from things like bank fees and interest. Those are really the two primary differences of why there might be a difference between your bank statement and what's going on in your accounting information system. So when there are discrepancies between the two, we have to make adjusting entries to make that adjustment for your cash balance. And that might be a debit or credit to cash depending on what's going on. If the difference is because we've earned interest on our cash, we would debit cash and credit interest revenue. If the difference was a deduction in cash because of a bank fee, we would debit bank fee and credit cash, right? So we have to make adjusting entries based off of the differences of our cash balance from our bank statement and what is in our accounting information system. So here we have an example of the bank reconciliation process. On the left side, we can see our bank statement. And as I'd mentioned, there might be some differences here. Uh, the cash balance might be higher due to interest revenue or uh, or lower due to a bank error or outstanding checks or whatever the case may be. So we go through the process of making the adjustments. So deposits in transit, bank errors, interest revenue, these are all reasons why your cash balance on your bank statement might be higher or why it might be lower due to outstanding checks that haven't been cashed yet, bank errors on the negative side, or interest expense, or some other reason why there will be a deduction from your bank account. So the additions minus subtractions gives us the adjusted bank balance, and we need to account for those changes in our accounting information system. So just as I described before, if we received interest revenue, we debit cash, credit interest revenue. If there are other expenses for whatever reason, like electronic fund transfer expense, service charges, etc., We would debit the expense and credit cash. And so at the end of the day, we need to make sure that our bank balance matches what's in our accounting information system for cash. That's the whole process behind a bank reconciliation. So here we have our example that we've been using throughout the semester so far. We have our brewing company. We have this is our bank statement. Here we can see deposits that we've made, service charges from the bank, checks that we've issued, uh, and our updated balances accordingly. And we also have some non-sufficient funds, insurance expense, etc. So what we need to do here is based off of this bank reconciliation, this bank statement, we need to make our adjusting entries accordingly in order for us to match our accounting information system to our bank statement. And so a couple of pieces of information here. Uh, we have our cash ledger there at the top. At the bottom, we have our bank statement. And so we have a check. Let's see. We have an account balance of 3,147 at January 31. We notice that the cash payments appear as one deduction or credit based off the cash differences. And so we need to make some adjustments here because we can see that well yes at month's end they match, but how do they match or why do they match? So there's a couple of things that we noticed that had happened based off of our bank statement. We have a deposit that's in transit, hasn't hit the account yet. There was a bank error of $100. We have a couple of outstanding checks that haven't been cashed yet. We have electronic funds transfer receipt for rent revenue 905 that hasn't been entered in our accounting information system yet. We have a collection of note receivable with some interest revenue. We have interest revenue. We have an error in our accounting information system. We have a bank service charge, non sufficient check fee from a customer that paid us and it bounced back. And we have electronic funds transfer payment for insurance. So, so these transactions all need to be reconciled with our bank statement. And the way that we make these adjustments are through adjusting journal entries. Regardless of the entries, at the end of the day, both the bank statement and what's in our accounting information system, also known as our books, need to agree. They need to balance. Yep, they need to be the same amount. So it's important that we understand exactly what's in transit, what hasn't been received yet, what has been received, any type of fees, any type of interest revenue. All of these things need to be accounted for. And so the way that we know what had happened is at the end of each month, we receive our bank statement and we make our adjusting entries accordingly to ensure that our accounting information system cash balance at the end of the month matches what is in our bank account at the end of the month. And so we do that, as I mentioned, through adjusting journal entries. These journal entries are posted to the general journal to cash reflecting its respective balance. And so this slide here shows us those transactions that were notified of and all of the respective adjusting entries. And so we went through, made our adjusting entries, and that at the very end, our cash balance equals what is in our bank statement. So the great news is because, at least in modern day We have so much that's going on with respect to online. A lot of my customers, and I'm sure a lot of yours, they pay electronically. It's relatively rare that I receive a check these days. It's mostly done through electronic funds transfer, which is kind of like a direct deposit, right? It makes my life a lot easier. Our expenses are a lot lower because of it. We don't have to worry about waiting on the mail, all of those things, right? So it keeps business operating a little bit more fluidly. And as a business manager or a business owner, it's important that you understand how to manage your cash effectively. And by one way of doing this is to encourage your customers to pay you electronically, so that way you don't have to continuously wait on the mail. Um, and the other great news is because of online banking, you can always know where your balances are at. So I'm sure a lot of you have an app on your phone for your banking. You just check it and it tells you exactly where everything's at. Now, of course, it might not tell you everything. For example, if you have like a hold for, let's say, a security deposit, uh, or um, uh, or let's say a couple of transactions that you've made that are still pending, uh, they won't be finalized until they hit the account. So, an example I give a lot is, let's say you go to the store, you make a purchase using your debit card, you come home and you look at your bank app and it says, oh, it's still pending. The reason why that says it's still pending is because on the retailer side, they at the end of the night they have to close out the batch for their credit card transactions, and so until they close that batch out, it's going to show as pending. And some retailers they wait, they might wait a day or two, sometimes 3 days, sometimes longer. Um, it all depends on the retailer. So that's why sometimes you might wonder, hey, it still shows it as pending on my account. That's the reason why. So let's talk about cash and what it looks like on your balance sheet. As you know, cash is the first thing that's listed on your balance sheet because it is the most liquid asset that the company has. Assets equals liabilities plus equity. We list out all of the assets in the order of liquidity. And of course, cash being the most liquid asset, it's always listed first. So some businesses might have several cash accounts. You'll see things like cash, cash equivalents, petty cash, checks on hand, those types of things. Those are all cash accounts. Okay. They're listed out in the order of liquidity. So cash is first, then you might have petty cash, and then you might have cash equivalents. Those are typically the order that they're listed out because they're the most ordered and the most liquid. Um, it's also important to note about with cash when it comes to investments. Short-term investments typically have a maturity date. The maturity date means when it's due or when you'll receive the payment by. This would be like certificate of deposit, money market funds, treasury bills. They all have a date associated with those. It's called a maturity date. When it matures is when it pays out. You can have it pay out before it matures, but the thing is you'll end up losing a little bit because you're pulling out the investment early. So just something to know. So now that we have a really good understanding of cash and how cash works, let's take a look at our receivables, the different types of receivables that we have in business. So there's really two major types of receivables that we have. One is our, of course, as you know, accounts receivable. That's when we made a sale to the customer of a good or service. Customer hasn't paid us yet. It created what we call an account receivable. It's due at a future date. And we also have what we call notes receivable. Notes receivable is when there's a promise by a customer to pay amount of cash at a future date, and it typically involves interest payment. So I'll give you a classic example of these. I had a customer one time. They said they were going to pay me in 30 days. So no problem. I created an account receivable for them in my accounting information system in my QuickBooks. They said that they were going to pay me 30 days. 30 days went by, and they paid. Great. So I debited cash and credited their account receivable to represent that I received the cash payment. Then I had another customer that promised they were going to pay in 30 days. So great. I debited their account receivable and credited the sales revenue. And 30 days went by and they did not pay. Okay, now I'm getting a little upset. So I send a notice. Past due. Pay now. 60 days goes by. Still no payment. Okay, so now I'm getting upset, right? It's like, okay, this person's not going to pay me. So past due, send another notice. 90 days goes by. Person still isn't paid. Okay, now I'm real upset. Now I'm thinking the customer's not going to pay. 120 days past due goes by. Customer's nowhere to be seen. Okay, they're just off the grid. I don't know what happened to them. So I got pretty upset. So now I'm getting ready to write off the debt because I think they're not going to be able to pay me back. So I'm going to just debit, bad debt expense and credit allowance for doubtful accounts. Because I figured they're not going to pay. So about 6 months later, the customer shows up. And I'm like, hey, what the heck? You were supposed to pay me for these goods that I sold you a while back. I go, oh, so sorry about that, Dr. B. I meant to pay you. I forgot to pay you. Um, so I said, okay, listen, because of this, what I'm going to do is I'm going to convert your account payable into a note your account receivable into a note receivable. Now, this is more like a promissory note, so there's some collateral involved. There's a promise to pay. Customer signs it, they agree to pay, and I'm going to charge them 15% interest, right? And it's due within 30 days. So at that point, they paid. But I wanted to give you that real life example because it helps you to better understand the primary difference between an account receivable and a note receivable. Other types of notes receivables could include a loan to an employee. That happens from time to time. It's called an advance on their paycheck. It's a loan to the employee, and we document that as a receivable. We also have interest receivables. We expect to earn interest on a note receivable, for example, so we document that as interest receivable. So let's talk a little bit more about these accounts receivables. Now, ideally, we want to get paid by our customers as soon as possible, right? That's why we even offer an account receivables because it opens up the ability for customers to pay us in different ways. So it's good for the company overall. We don't like receivables because there's always that possibility that a customer is not going to pay us. But we accept accounts receivable because, hey, listen, it's just another way for us to earn more customers, right? So we prefer cash, but we can issue an account receivable if we need to. It's like granting credit, right? So what happens when the customer don't pay us? Well, we have to write off that account receivable. When we do that by through a process called bad debt expense, right? So we debit bad debt expense and we credit an allowance for bad debt or allowance for doubtful accounts. This happens from time to time because not all customers are going to pay you. We hope that they do, but some won't. So when that happens, we use this account called bad debt expense. It's a selling expense caused by uncollectible accounts. So once in a while, the customer's not going to pay you, and so that's an uncollectible account. Companies try to make sure that the sales on account expect that the benefit granting the credit outweighs the cost. We always try to gauge the risk of the customers not being able to pay us back. So we offer accounts receivable, but we also run the risk. Yeah. So that's what that tells us. So when that happens, there's two ways that the company could write down this uncollectible account. One's called the direct write-off method, and the other one's called the allowance method. I'm going to talk about both of these here briefly. So for the direct write-off method, it's the method of accounting for uncollectible accounts where the customer's account is written off as uncollectible when the business determines that the customer will not pay us, right? So I gave you the earlier example of the customer that kind of went missing. I was preparing to write off their account. And the way that I would do this is debit bad debt expense and credit their account receivable to write off the account receivable. So here we have our example of our brewing company. Customer didn't is determined uncollectible. We debit bad debt expense and credit account receivable. So we send notice after notice, and then once in a great while you get lucky, and the customer comes back. They's like, "Oh, so sorry, totally forgot to pay you." So great, we debit account receivable, credit the bad debt expense to reverse the bad debt expense. And then we debit cash and credit the account receivable to recognize the payment that the customer paid us. So that's great when that happens. It doesn't always happen that way. So that's the direct write-off method. The other method is called the allowance for doubtful accounts method, also known as the allowance method. Allowance method for accounting bad debts in which the bad debt expense is recorded at the same time as the sales revenue. We use this as a way to estimate the amount of accounts receivable that we expect we will not be able to collect in the future. This is in adherence to generally accepted accounting principles and a part of the matching principle. So under the allowance method, the company uses an adjusting entry at the end of the accounting period. We debit the bad debt expense and we credit an account for the allowance for doubtful accounts or allowance for uncollectible accounts. That's another name for it. And again, this is just we're estimating that a certain percentage of our credit sales, meaning our account receivable sales, are going to be uncollectible at some point in the future. Oh, sorry. Uh, so here we see the adjusting entry. We debit bad debt expense and credit allowance for doubtful accounts. And it's based off of really a percentage. Is the easiest way to do it, or you can do it by what we call the aging method. It's an estimation, right? That's what I call it, the allowance method. We're allowing for this to happen to some extent. It's an estimate. And so in this, what I usually do in my business is I expect that about 3% of my customers that purchase from me on account, meaning accounts receivable, about 3% of that total is not going to pay me back. And so I take the total expected sales, multiply that, I'm sorry, total expected credit sales, I multiply that amount by the 3%, and that will give me my bad debt expense for the allowance method. Now, as the year goes on, I'll adjust this based off of what actually happens. So estimating, we can do this in one of two ways. We estimate the bad debt expense based off of our history. And the way I do it is the percent of sales method. And the other way we can do it is based off of what we call the aging method. The aging method tells us how long it's been since the customers have paid us, or how many days past due it is. And some factors that we do take into consideration when making our estimates is the state of the economy and the industry that we're in. So here we have the percent sales method. So we take our total credit sales, we multiply that by the percentage we expect not to be collected, and that'll give us our estimated um, amount that we're not going to be able to collect. So here we have some information for our company. We have uh, we have our accounts receivable, bad debt expense, and allowance for doubtful accounts. Uh, so accounts receivable, we have a balance of 66,500. Allowance for doubtful accounts 250. Bad debt expense 0. So taking these into consideration, by using the percent sales method, we take our credit sales, we multiply that by our estimated percentage that we're not going to be able to collect. So in this example, we're simply saying here that, hey, we believe that 2.5% of our total credit sales is going to be uncollectible. So, I'm sorry, one fourth, I'm sorry, 0.025%, also known as one fourth of 1%, is going to be uncollectible. And so we take our total credit sales, in this case, 1.47 million, and we multiply that by our one fourth of 1%, which is 0.0025, which tells us that about $3,675 is going to be uncollectible. So we debit bad debt expense and credit allowance for doubtful accounts for those amounts. Now that percentage that this example is using is not going to be the same for every company. This is just an example. The percentage is going to be based off of the company's history, the industry that the company's in, the current economic conditions. All of those become factors in determining the estimate for using the percent of sales method. So, and then this is what our account balances look like afterward. So we still have our account receivable 66,500. We've added in the allowance for doubtful accounts 3675 to our existing balance. So we debit bad debt expense 3675 and credited the allowance for doubtful accounts 3675. And we now see our allowance for doubtful accounts balance sitting at 3,925. So that is the percent of sales method. The other method is called the aging method. Now, as the name implies, we can generate a report called the aging report. That's what it's called. And it's an account receivable aging report. And what it does is it shows us a list of all of our customers, their current balances, and if they owe us anything that's current, uh, 30 days past due, 31 or more days past due, 61 or more pays, 30 days past due, 60 days past due, 90 days past due, 120 days past due, 180 days past due, etc. Okay. And so based off of that aging report, I can estimate how uh, how much we're not going to be receiving back. Now, here's how this works. It's pretty straightforward. For our company, we say that, hey, 2% of our current customers are not going to pay us. So the way that we do that is we would take the 2%, multiply that by the 57,250, saying, hey, that amount's not going to pay us back for the current. As the aging report gets older, meaning the invoices become past due, 1 to 30 days past due, 10% of those aren't going to pay us back. 31 to 60 days past due, 20% not going to pay us back. 61 to 90, 40%. 91 to 180, 70%. Beyond 180 days, 90% not going to pay us back. We, those percentages, again, are estimates, and they come from the company's history of knowing, hey, what has happened in the past. So, so here we apply those percentages to the balances. So we take the balance, multiply that by the uncollectible percentage, giving us the estimated uncollectible amount. We just add those all together. And in this case, we say $3,035 will be uncollectible during this period. So, looking at our accounts, we've adjusted downward by 250. So we debit bad debt expense and credit allowance for doubtful accounts to represent the journal entry that we would make using the aging method. And updating our balances accordingly, we can see using the T accounts where we derive those figures from. Yep. So, so that is the aging method. So regardless of the method, we need to make sure that we account for this. Now, let's say, for example, that we had a customer that comes back and they pay. Well, then we will need to reduce the allowance for doubtful accounts by that amount and reduce the account receivable by that amount. And then as they pay us, we go through that process to adjust downward. So if they don't pay us or they unexpectedly pay us, then we make the adjustments. So we debit the account receivable, credit the allowance for doubtful accounts. What this does is it reinstates the account receivable and reduces the allowance for doubtful accounts. And then we debit cash and credit the account receivable, representing the cash that we're actually receiving. This summary slide, love this slide, great slide. Recommend that you look closely at this slide. What this does is it gives a nice comparison between the direct write-off method and the allowance method for doubtful accounts. Yeah. Typically the company will select one of these two methods. It depends again in the company's circumstances and where everything is with them. Yeah. So just to give you kind of a quick example of the situation, looking at uncollectible accounts based off the aging schedule. We assume that instead of $1,200 credit balance, the allowance for doubtful account has 700 debit balance before the adjustment. We can make an adjusting entry to reflect this change based off of the percentages. And so, just as we did before, we would take the uncollectible percentage, multiply that by the balance, and add them all up over the period. And then we adjust out that $700 debit balance that we had before, and we would debit bad debt expense and credit allowance for doubtful accounts. Uh, and so, yeah, that's the overall process. So the next thing I would like to show you are your accounts receivable on the balance sheet and how these are represented. So looking at our accounts receivable, very simple. As you know, it's usually the second item that shows up on our balance sheet because they're liquid. They're just not as liquid as cash is, of course. The accounts receivable report represents the total value or the total net realizable value of your current accounts receivable. If you were to double click on accounts receivable on that amount, you can zoom in and you'll be able to see a list of all your customers and the amounts that they owe you. Yep. So it's very simple. Accounts receivable, very, very simple. Okay. Oh, and what you'll see on your accounts receivable is you got your beginning balance accounts receivable minus allowance for doubtful accounts, gives you the net realizable value of accounts receivable. That's what this shows. Because the thing to remember is that allowance for doubtful accounts is a contra asset account, very similar to accumulated depreciation. It deducts from the account receivable instead of obviously fixed assets, but uh, allowance for doubtful accounts is a contra asset account. It contra flows from the accounts receivable. So that's accounts receivable. Let's talk very briefly about notes receivable. A note receivable, as I had mentioned earlier, is a promise to pay by the customer at a future date, and it typically includes some type of interest. So it includes these elements. It's a there's a promissory note, there's the maker of the note, the person paying or the payee, the principal amount, the interest stated interest rate, the maturity date, what when it's due, the maturity value, the total amount of what will be paid at the date of when it's due, and the note term, how many days is it for? Here we have an example of that promissory note. So we can see the principal amount, $600. The date of the note uh, is March 31. That's when the interest period starts. Who's it being paid to? The payee. The amount, the principal, when it's due or the maturity date, the interest rate, and the maker. That's the customer. So when there's an origination of a notes receivable, we t there's it's why does it happen? Sometimes a business will lend money to a customer or to a vendor. The company is providing goods and services in exchange for a promissory note instead of an account receivable. Or we've converted the customer's account receivable into a note receivable. So here we have a couple of examples. Company, our company lent $200 to an individual, 3 month, 6% note. I don't know who would ever do this, but I guess it happens. So we debit note receivable, credit cash for the issuance of that loan. Uh, at the interest 6%. Let's see here. I'm sorry. So that's one example. Another example. The cost. Our company sold goods and services to a customer for 1,250. Yeah, $1,250 on a 9 month promissory note, 7% interest rate. Debit notes receivable, credit sales. Now, here we have an example where uh, the customer cannot pay on their account. So we're going to convert it to a note receivable. So we debit note receivable and credit the account receivable. This is a conversion into a note receivable. And in this case, we're saying, hey, not only are you going to pay us the $100, you're also going to pay us within 60 days at 14% interest. The way that we compute interest is a very simple formula. This is called the interest formula. You'll see this a lot over this class, your managerial accounting class, and if you're in the accounting program, you'll see it again intermediate 1, and probably a few times thereafter. So a very important formula for you to know. So the interest formula is principal amount times the interest rate times the time. So for example, principal amount $600, interest rate 10% times time 1 year, or 12 over 12, represent a full year. The interest expense would be $60 in this case, or the interest revenue would be $60 in this case. Here we have an example, $1,500, 8%, 9 months. So 1,500 times 0.08 times 9 out of 12 months gets us to $90 interest. Another example, $5,000 note receivable, 12%, 90 days. We assume that when it's expressed in days, we assume that the calendar only has 360 days in a year. The reason why 360 days and not 365 days is because there are 360 banking days in a year. We do not count federal holidays as banking days. So that's why it's 360 and not 365. So principal times interest rate times time gets us to, in this case, $150 interest revenue. Uh, how much did we earn in 2018? Principal times interest times time, $45. At the end of the accounting period, we make an adjusting entry to reflect the interest revenue received, debit interest receivable, and credit interest revenue. So remember, we have to recognize revenue when it was earned. And so we need to make adjusting entries in this case. Okay. So interest revenue, principal times interest times time. In this case, 15. This was for the following year. So for the total life of the note, the 90-day note, we debit cash 660. That's what we actually received. We credit the note receivable 600. We credit the interest receivable 45 from the prior period. And we credit interest revenue from this period of $15. One of the other things I want to talk about very briefly are a couple of ratios that you should know. These ratios help us to understand um, our cash position. The first one is called the current ratio. I love this ratio, very important ratio to know. It tells us about the company's ability to repay its current liabilities. It tells us about the company's ability to repay its current liabilities. One of my favorite ratios and probably one of the most important ones in business. To calculate this, we take our current assets and divide that by our total current liabilities. Very easy ratio and also very important one. The next ratio is called the quick ratio or acid test ratio. And this, we take our quick assets divided by current liabilities. Quick assets are assets that we can quickly convert into cash. These include cash, accounts receivable, and short-term investments or cash equivalents. These do not include inventory. We do not include inventory in this ratio because inventory cannot be quickly liquidated. Okay? So in this case, cash, cash equivalents, short-term investments, and accounts receivable. Those are your quick assets. So we add those together and divide that by current liabilities to get our quick ratio. Here we have the example of that from our company. So current ratio, current assets divided by current liabilities. In this case, we have 1.72, pretty good. Yeah, and anything really above 1 is considered okay. Anything above 1.25, 1.5 is considered to be pretty good. For the quick ratio, in this case, it's 1.22, also good. Anything above 1 is considered good. If it's at 1 or below 1, the company's in trouble. Two more ratios I'd like to talk to you about today. One's called the accounts receivable turnover ratio. This tells us how quickly we're receiving the cash from our accounts receivables from our customers. This we take our net credit sales divided by average accounts receivable. Now remember, to find the average of something in accounting, it's the beginning balance plus the ending balance divided by 2 gives you the average. And the other one I want to talk about is the receivable collection period. Receivable collection period, basically how many days it takes to collect from our customers. Uh, Average net accounts receivable, beginning balance plus ending balance divided by 2, divided by net credit sales over 365 days. So in this case, here we have the following information. We turn over accounts receivable 8.98 times. That's pretty good. And it takes us about 41 days to collect from our customers. That's a little slow. Yep. And of course, it depends in the company's overall uh, terms. Some have 45 days, some have 30 days. 41 days, a little slow, in my opinion. I try not, at least in my business, I try to limit my my myself to 30-day terms because the faster I can collect from my customers, the more efficiently I can use that cash over time. So just something to consider. And the last thing I want to talk about today is called the petty cash fund. These are pretty common in businesses when it comes to like paying for small things, small quick things. At the hotel, we used to have a petty cash fund at the front desk, and it was used for the company would use it to pay for like small things like postage stamps, shipping of small packages, paying for a customer's cab ride from the airport, just small expenses. And so, of course, the way we would track everything are through receipts. We would reimburse the account based off of the amount of receipts that we'd have in the fund. And it's really designed to support small transactions. So, uh, in order for us to establish the petty cash fund, we need to create a new account. The way we do that is we debit petty cash and credit cash. This creates a separate petty cash fund. And then over time, we start using the petty cash for various things. Um, so let's see, we have $25 reimbursement for envelopes, 108. $108 in cash on hand at the end of the month. We take all of our receipts. We then make journal entries based off of all those receipts, and we reimburse the petty cash fund. Sometimes errors are made, and so there might be an over or under with respect to the petty cash fund. That's not great when that happens. Typically, a business will not reimburse for the loss of the petty cash fund, so just be really careful if you do end up using one of these in the future. So to replenish the petty cash fund, we debit all the expenses based off of the receipts. We debit or credit cash over or short, depending on the situation. And then we credit the cash to replenish the petty cash fund. Um, and then to charge the petty cash fund for whatever reason, we just debit petty cash and credit cash. So, these last few slides are just the chapter summary. So please definitely read through those. I do appreciate you listening to today's recorded lecture. Uh, as a reminder of what we have to do for this week, we have our assignment related to this chapter. So please refer back to this, refer to the PowerPoint, refer to your notes to complete your chapter assignment for this week. Thank you so very much for your time today. I sincerely appreciate it, and I wish you all the best. And I will see you again shortly. Thank you so much. Take care. Bye bye.